Hey everyone, welcome to another episode of the Launchpad webinar series. And in this session, we'll be speaking all about budgeting and forecasting. So in a previous session, I spoke about search engine optimization, SEO, and the fact that a lot of founders find it quite intimidating and therefore just avoid it. Well, budgeting and forecasting, in my experience, is number one on the list of things that founders do not want to do. And I get it. If you don't like numbers, if you don't like looking at spreadsheets or thinking about forecasts, then this is not for you. However, hopefully in this session, what I could do is convince you why it's so important and so beneficial to your business to have a robust, credible budget and forecast. So I've called this session Your Budget, the Engine for Business Growth. And in this session, we'll be talking about a few things. So first of all, what is a budget and why is it important in business? We'll then be talking about budgeting for growth, my 6-step process for you to create a credible budget. And finally, we'll be talking about forecasting. Forecasting in itself is a huge topic, but in this session, I want to give you an introduction to some of the key principles that can help you forecast for your business. So, what is a budget and why is it important in business? So, in business, a budget is a financial plan outlining expected income and expenses for a specific period, used to manage resources, track performance, and make informed decisions. And there are a number of reasons why having a credible budget is beneficial to you and your business. So, first of all, tracking performance. An effective budget should give a business the tools to track how the company is doing financially. Decision making. It can help you plan for both short and long term expenses, for everything from new hires to the cost of expanding operation. Stakeholder confidence. It can also give a company the ability to share its process and budget with a governing body, like a board of directors, for example. Preparing for emergencies. It can help you set aside money for an emergency so you don't have to divert funds from other parts of the business. Attracting investors. It shows investors that you are organized and committed to the business. It gives them insight into a business's future potential. And then finally, preparing your taxes. Anybody who's heard me speak about budgeting in the past will probably have heard me reference HM Revenue and Customs as the biggest gangsters in the UK. That's because they always get their money. So it makes it easier to complete taxes and give you a good idea of how much you owe. Now, there are a number of reasons why not having a budget can be detrimental to your business. So it means that you won't have a good idea of how your company is performing. You have an inability to expand operations or expand into new markets. You'll also be unable to secure loans or make large purchases necessary for your business. You'll have no contingency fund, no money for a rainy day. You also won't be able to secure investment. And finally, preparing taxes will be difficult. And if late, you may incur fines. So I want to introduce you to my 6-step process for creating a credible budget. And to do that, I've invented a fictional footwear brand called Kit, who sells sustainable footwear from recycled materials for £30 retail. Currently, they only have one product, their flagship trainers, but they do want to expand into other variants in the future. I do want to highlight that this is a startup brand, so they've got no revenue at all at the moment, but the principles that we'll be covering will also be relevant to an organization no matter where they are in their journey. So, step one is about understanding market potential. Step two is about setting strategic goals. In step three, we identify our cost of goods sold and expenses. And in step four, we set our revenue and profit targets. In step five, we set budgets for our expenses. And finally, in step six, we secure resources and then execute. So, step one is understand market potential. Now, the reason why this is so important is by understanding the market potential, the total amount of money you could make from your business, it'll help you understand how much money you should invest. If it turns out that you've got an incredibly large market that you're playing in, it will give you the confidence that spending money may result in a return. However, if you determine that your market is relatively small, it should temper your expectations with respect to how much you should spend and how much you return. The total addressable market is simply all of the potential customers who could be in the market for the products or services that your startup is offering. Now, in this instance, we're looking at the global sneaker market. So there are multiple ways that you can determine the total market. You could do a top-down analysis, you could do a bottom-up analysis. And if you'd like to explore those in more details, let me know and I can make a video about it. But for the purposes of today's discussion, we've identified that the total addressable market for the global sneaker market is 80 billion pounds in 2025. Then we've got the serviceable available market. Now, this is the portion that a company can realistically target and serve with its current resources, capabilities, business model. Now, if you think about the total addressable market, that's everybody in the world who could make a purchase. Now, it's unrealistic to expect that your startup could and would serve them all. So, our serviceable available market narrows that down to who we could realistically serve with our current capabilities. And in this instance, we've identified the UK sneaker market at 4.4 billion pounds, and specifically the 18 to 34-year-old demographic, which is about 40% of that market. So that gives us 1.8 billion pounds in 2025. Still a huge number. But now we're going to go one step further and look at our target market, which is also known as the serviceable obtainable market. And that's a group of customers within a business's serviceable available market at which a business aims its marketing efforts and resources. So in this instance, we're looking at what we could realistically target with our available capability. And we've provided a very conservative estimate of 0.005%, which may seem very small, but you know you're in a good market when 0.005% of it is 90,000 pounds. And what that tells us is that if we were able to grow our market share to 1%, then we'd be in a very, very comfortable position. So that's stage one. Stage two is that we set our strategic and financial goals. And we've got three here for kicks. First of all, penetrate the UK sneaker market. And we've measured that, or we will measure that, by completing 30,000 online sales. We then want to expand customer reach by 2025. And the way that we want to measure that is having 1 million unique online impressions. And then we also want to establish a strong positive reputation. And we'll measure that by achieving 300 5-star Trustpilot reviews. Your finances are a key tool to help you achieve your strategic goals. For example, you can create a budget for innovation, marketing, research, or growth. You may have explicit financial goals, however, but they'll likely be linked to other related factors. For example, improving profitability could be linked to transitioning to cheaper suppliers or increasing the price of your products. And finally, financial targets can be derived from your strategic goals. For most organizations, your finances are a way of measuring performance. In this instance, we know that completing 30,000 online sales directly relates to our target market figure of 90,000 pounds. Stage three, identify your cost of goods sold and expenses. So cost of goods sold, or COGS, are the direct costs of producing your goods and services. Now, this is not an exhaustive list, but you can imagine, depending on the product or service you're offering, you will have to spend money to be able to deliver those. And these are things like materials, manufacturing, packaging, shipping, direct labor, and many more. But we'll keep it short just for the purposes of this example. And then we've got expenses. And these are the operational costs that help to maintain the business. And again, not an exhaustive list, but we've got things like utilities, your accounting fees, payment processing, online infrastructure, marketing, storage costs, office space, business insurance. So now that we've identified our costs and goods sold and our expenses, we can move on to stage four, which is set your revenue and profit targets. So revenue is the total amount of money a business earns from selling its goods or services. It is a way of measuring your company's market penetration. And based on the market analysis, the revenue target that we've identified is 90,000 pounds, which equates to 30,000 online sales. Now notice we've got another revenue line here, which is third-party distribution, which is currently at 0. So this is the idea that at some point in the future, we would like to work with third-party retailers to stock and sell our trainers on our behalf. Now, we haven't got that yet, but it's an ambition for the future. So we've included it because in future years, we want that line to go from zero to something substantial. Now, profit is a financial gain a business makes. It's calculated by subtracting all expenses from your revenue. It is a way of measuring the value and efficiency of your company. Now, Kicks will target a 20% operating profit, which means that we can spend £72,000 on inventory and expenses. Now, on to stage 5, which is set budgets for your expenses. Now, once you know what your profit target is, you can now start looking at your budget. Now, your profit margin will be highly dependent on your company's business model. So in this instance, we've set ourselves a target of 20%. Now, if we were in a high margin business, for instance, software or IT, we could increase that number significantly. However, if we were in a low margin business like the airline business, then we would have to reduce that significantly. So your realistic margin is going to be wholly dependent on the industry that you're in. Now, first, we have to focus on fixed costs. These are the costs that don't change no matter what. These are normally your expenses. So you can imagine when it comes to office space that you're renting, you can't go to your landlord 1 month and say it's been quite difficult. We haven't sold as many trainers. Therefore, could we have a reduction in our rent this month? They'll laugh you out the room. However, when we start looking at our costs of goods sold, these are more variable. If you sell more trainers, then you can spend more on stock. If you sell fewer trainers, you don't have to spend as much. So we normally look at what are our fixed expenses, what do we have to spend money on before looking at our variable expenses. So that's our budget. For us to achieve a revenue target of £90,000, we can spend £72,000. £45,000 will be spent on the cost of goods sold. So actually the materials and manufacturing, packaging, etc., that go into creating the inventory, and the remaining £29,000 can be spent on other expenses, the general expenses that keep the business ticking over. And we've got budget targets for each of the different line items identified. Now, it's a very crude example, but hopefully it gives you an idea of how a budget can help you limit your spending in certain areas. Now, if you need to spend more in one area, then the money could come from one of the other areas. Maybe you look at reducing your online infrastructure costs by going with a different supplier. Maybe you downsize to a smaller office space so that you stay within budget. So these are the types of things you can do in order to make sure that at the end of the year, you're still profitable. But now you have that budget. The question is, where does the money come from? So in stage 6, we finally talk about securing resources and executing. Now, I want to highlight 3 key ways that you can raise capital to deliver your vision. The first is known as bootstrapping. So that's funding your business using personal resources. So that's time and savings, and reinvesting profit back into the business. It's known as compounding. So the pros to this is that you own 100% of your business, and you also have full control over your business decisions. The downside, however, is that growth will likely be slow. And I'll illustrate that by talking about some of the other ways that you can secure resources. So debt financing. So raising capital by borrowing money from a lender with the promise of repayment, typically with interest over a set period. Now, the pros here is that it facilitates growth faster, because by going to a lender, you may be able to secure a lot more capital investment to spend on your business. And that means maybe more to spend on marketing, on promotions, on branding to help your business stand out and secure additional revenue. The downside, however, is that interest rates can vary, and maybe you find yourself in a particularly difficult situation, and the interest rates can negatively impact your cash flow. Also, legally enforced repayments. Now, it doesn't matter how well or poorly the business performs, the lender wants their money. So if the business is underperforming, you'll still find yourself in a situation where you have some potentially high repayment costs that you'll have to factor in. Finally, equity financing. And this is raising capital by selling ownership, shares, stock to investors who become part owners of your company and share in profits and losses. So the pros here are that it facilitates faster growth. Again, because through equity financing, you may be able to secure much more than your original budget, which allows you to inject more funding into some of the things that will help your business grow rapidly. Sponsorships, for example, or working with very well known influencers. The other pros include access to expert mentoring. So, the value of working with an investor who's well regarded is that you will also have access to somebody who has been there, done that when it comes to business and can provide you with useful insight. They can also give you tools and resources to help you expand your business, such as their network, which will be as valuable as their investment in some instances. The con, however, is that you lose full ownership. Your investors become a part owner in your business and therefore play some role in the decision making side. So we've looked at our revenue target, but what does that revenue target look 3 years out, 5 years out, or even 10 years out? To do that, we can forecast. What is a forecast? It is a process of projecting future financial performance based on known available data, trends, and drivers. It is an art, not a science. It is based on justifiable assumptions about how economic forces, trends, and drivers will impact your customers' behavior. And it utilizes a mathematical action known as extrapolation. And here are some examples of extrapolation where the green line represents known data and the red line represents our future interpretation. So this is where the performance of your business follows the trend. Based on some economic factors, you may find that your business is likely to underperform in future. And based on some emerging trends and drivers, you might find that your business is expected to exceed the trend in future. So these are all examples of forecasting into the future. So I've mentioned trends and drivers quite a bit. Now, talking a little bit more about that, trends are consumer purchasing patterns that businesses may need to respond to depending on their impact on the market. These are things like quick commerce or contactless payments, buy now, pay later, all examples of the ways that consumers are interacting differently with brands. And then you have drivers. So, drivers are the factors that cause unavoidable changes to a customer's behavior. Some drivers lead to new trends. So we've got UK bank lending, for example. We've got the US government enacting a nationwide TikTok ban. We've also got climate change. These are examples of drivers that force people to act differently. Now, there are a range of different ways that you can take that information, take previous data, and use it to create a forecast. Now, for the purposes of today, I just want to give you a very quick overview. But if you want me to delve into some of these different methodologies in more detail, let me know, share a comment, and I'll be happy to put a video together. So let's look at some of the trends which will impact our brand, Kicks. We're seeing a rise of sustainable fashion, which reflects a growing customer awareness of the fashion industry's environmental and social impact. We're seeing a rise in walking. We're seeing that people are taking more walking trips than even pre-pandemic levels. And why is that important? Because, well, more walking trips means more worn out trainers, which means more trainer purchases. A negative trend, however, is the cost of living crisis. As the price of essential goods and services go up, then the likelihood of people to purchase luxury items like fashionable trainers will decrease. And finally, we have a negative driver in the form of export barriers. We're seeing that mid-sized firms are being stifled by export barriers and rising costs. Now, for us, if we have any materials that we're procuring from overseas, that could increase our costs and therefore increase the cost that we have to retail our shoes at, which would make them less attractive. So, taking all of those into consideration, my determination is that in the near term, we'll see an underperformance, mainly because I think the cost of living crisis in particular is really going to stifle people's spending power. And also, if they are going to buy a luxury product, they'll probably buy it from a more well known entity as opposed to a startup. So, hopefully, that was a useful roundup of all things budgeting and forecasting. As I said, it was an overview, but if you'd like me to go into any more detail in any specific areas, by all means, get in touch and I'll do my best to put something together. But in summary, I'd like you to take away some key points. So, first of all, maintaining your budget is a vital business activity. It is critical to ensuring you have clarity regarding your business's financial performance. Forecasting is an art, not a science. It is based on justifiable assumptions about how economic forces will impact your target customers' behavior. And finally, do your research. The more you understand the market and economy, the better confidence you will have in your forecast. So, hopefully, you found that useful, and hopefully, I helped to demystify something that some people find quite intimidating. But if you've got any more questions, if I can help with anything, by all means, get in touch. But in the meantime, have a great week, and I'll speak to you soon. Take care.